So in this video, we're going to talk about some basic foundations of investment theory. The efficient market hypothesis seeks to explain how efficiently information is incorporated into the price of securities. Behavioral finance is a relatively new field that seeks to integrate investor psychology with investment theory. Technical analysis is the process of analyzing data, such as prices and volume, to predict future price movements in a stock or market. So, what is market efficiency? The general idea is that information creates prices in securities. As we get information, we analyze and then trade. So there are two basic questions. Number one, does the information provide enough data to make a trade? And two, how long does it take for the information to get into the price? So how can we achieve efficiency, right? So we need to have many investors analyzing the data. There has to be a population that's out there analyzing, reviewing information, and then making trades. We need information that comes randomly, right? We need information that comes, but we can't expect it to come. We can't rely on it to come. It has to come randomly to us. And then finally, investors and prices, we need to be able to react quickly. So it's not just that the price changes quickly, it's that you and I can also make trades quickly. So what's required then, again, for this market to ultimately be efficient, right? So there's a combined effect, if you will. If the information arrives randomly and independently, and many investors react, prices should change randomly and therefore be an unbiased reflection of that information. The returns should also be consistent with risk. So there's the impact of those previous three things that help us make the market efficiently. They all work together. We can't have them coming independently of each other. So what are the three forms of market efficiency? Well, the weak form uses historical information. So it could use prices, returns, volume data, any other kind of market generated information. The semi-strong form uses all public information. This obviously contains then historical information, but it also uses things like earnings per share announcements, stock split announcements, think of anything that is a current event that is provided to the public by a company. That's the information that's in semi-strong. And then the strong form uses all information, not just the public information from the semi-strong, but it also assumes that we have private information or inside information. So ultimately, how do we test whether or not the market is efficient, right? So if I use information to analyze a stock, will the price move in the right direction? In other words, do prices move correctly? Does information go into the analysis, and the analysis ultimately help us understand which direction price should go? And then, will I be able to gain an advantage over the market? Now, this is where people get a little confused, right? We're not saying if the market is not efficient, we're not saying that you will lose money. What we're saying is you cannot beat the stock market on average. So again, can I achieve an above average return that exceeds the market return? So two basic kinds of tests. We need to run a test on whether or not returns are independent or are they related to each other. And then what are the risk return results compared to a buy and hold strategy? So I have a strategy. We need to know whether or not the returns are independent, and we also need to know whether that strategy will beat something where I would just buy and hold and not make any changes or any trades at all. So we need to have a trading rule, right? Again, lots of people have their own rules, right? They determine what the rules are. The question is, does that rule actually work consistently, right? If rules work consistently, people will determine what those are. Eventually, they'll figure them out. And of course, if everybody's using the same rule, we would think that trading activity would eliminate the benefits from that rule. So in this example, we're just saying, look, we're going to use a 50-day moving average. If the stock goes above that, we buy it. If it goes below it, we sell it. Now, if I can earn an excess return, that is a higher return than the market, then the market would not be weak form efficient. In other words, if I can't beat the market, then it's efficient. But if I can beat the market, that means I can use this information to an advantage. We would then say that it is not efficient. So how do we test semi-strong forms, right? So we might predict future returns beyond some pure market information, right? So maybe one of the things we could look at is earnings per share, right? So what we refer to these as event studies. Something happens that's fairly regular, and let's say its earnings per share are announced obviously quarterly, and we have an expectation of what that is. Now, when I actually publish my earnings per share for the quarter, how close am I to the expected? That difference, right? If I have more than expected, that's obviously positive. We would expect the stock price to rise. We want to test my ability to trade on that information and earn excess returns. And then to test the strong form, we're going to look at a specific group of investors, right? And see if they have some form of advantage, if you will, to outperform the marketplace itself. So in 2007, the SEC enacted Regulation FD that prohibited public companies from selectively disclosing private information. This should mean that that analysts no longer have valuable private information. Again, by definition, if we start to distribute it away from those insiders to someone else, that information now should be public. What they're saying is we were playing loose with that, giving the information to some investors, but not all investors. So again, testing the strong form would be testing whether or not any one group of investors have an advantage. So what is the summary research? Well, there are some things referred to as anomalies. What is an anomaly, right? It's something you see, but it shouldn't be if the markets are working efficiently. One of the things that we could talk about is something called the January effect. And this is where stock returns, especially small caps, have frequently been higher in the first days of the year than any other time during the year. Now, of course, everybody knows the month, so you would think if you could get higher returns in January, and everybody knows that, everybody should be trading that way. That trading should eliminate this event, but it doesn't. It still exists. So there are lots of these anomalies. There's some short-term momentum. There's some long-run reversal kinds of things. Again, I'm not really familiar with that information. Dividend yields. There's lots of studies done on dividends, on earnings. If you look at value stocks, a stock classified value, typically they outperform. Small company stocks, they particularly outperform large company stocks. Again, everybody knows you're a small company, so everybody trading this way, you would think, would eliminate this. So again, one of the things that we haven't mentioned, right, is what we refer to as market frictions, right? We haven't talked about those things that eliminate returns, which are things like taxes and commissions. Once we incorporate taxes and commissions into the calculation of returns, since that erodes the return that we earn, we frequently find that we are not going to be able to consistently beat the market after tax and after commissions. So what are the issues that cause problems with these tests of efficiency, right? Well, first of all, there's some behavioral issues, and we're going to talk about that in a little bit in the next video. But how people react, that psychological impact, that will affect tests of efficiency. I already mentioned things like frictions, taxes, and commissions. And quite frankly, then, most strategies are tested per a vehicle, right? Some type of a model. We're going to talk about the capital asset pricing model here in a video on down the line. So we use that capital asset pricing model to tell us what the return should be, compare that to our return, and then determine whether it's better or worse than the stock market. But what if the capital asset pricing model is wrong? So there are all kinds of challenges with any test that we do in the market. So the issue in the end, right, is one of the things that many people question or ask about is the idea of bubbles, right? A bubble necessarily isn't an anomaly, right? A bubble is a situation in which prices are just moving far away from their intrinsic value for a period of time. The tech bubble in the late 1990s to 2000, extremely high returns, right? So after these stocks peaked in 2000, they dropped about 80% after that. We're currently in what some people have been concerned about, another kind of a tech bubble where AI is driving a lot of these very large tech companies. And many people are concerned that we're in the midst of a bubble, right? So can you see it coming or going? Typically, we don't know it's here until it's gone, right? So it's very difficult to react to these things. So again, that's the end of this video. Look forward to seeing you in the next one.